To become a successful and good investor, press the bell icon and get good advice. Many of you had requested that I make a video on discounted cash flow, that is DCF. Also, many of you wanted a demo of the course. You can find the fair value, that is the intrinsic value of any share without using any complicated Excel sheet or complicated formulas. You can value any share, and you will get many more videos and text lessons like this in my 1 year investing course, Academy of Value Investing, whose link you will find on the card above and in this video's description. And this course has content available in both English and Spanish. So let's start today's demo video in which I will tell you what is discounted cash flow. Let's start with a simple question. If I tell you that today you have an option that you can take $100 from me today, or option B is that you take $104 after 1 year. Today you can take $100 or after 1 year 104. Which option will you choose? You see, if I were in your place, I would choose option A. If I get $100 today, then in 1 year, if I just put it in a high yield savings account or CD, then after 1 year, I will get around 5% return. That is $105. So in this, what did you do? In this, you saw where you are getting better returns and which investment avenue suits you. So when we pick shares too, we have to see the same thing, that the return we are going to get, the expected return, if I buy the share at this price today, is the expected return reasonable or not? Compared to the risk I am taking, will I get the return or not? So for this, we use the discounted cash flow method. So now what is this discounting or discounted? You can understand it as the exact opposite of compound interest. Like in compound interest, what do we do? If today $100 is there, after 1 year at 10%, it will become $110. But if it's the opposite of this, if I tell you that after 1 year you will get $110, then how much money will you buy it for today so that your return is 10%? So when we come back from future value to present value, this is called discounting. When we go from present value to future value, this is called compounding. If you give me this option that after 1 year I will get $10, then in exchange, how much money will I give you today? So if I give you $10 today and in return I get $10 after 1 year, then my return is not just zero, but actually negative because of inflation. So why would I give $10 today to get $10 after 1 year? I won't. Will I give $9? If I am giving $9 today and after 1 year I am getting 10, then my return is coming around 12%. And I think this is a very good return. This return I might get in stocks, but won't get in mutual funds or any other asset class. So if I am getting 25% return, then I will definitely do this deal. So the fair value of next year's $10 for me today is $8. In exchange for $10 next year, I will give $8 today. Till now, the examples I gave, in those the calculation was easy to do because things were fixed. You knew that next year you will get $10. In the previous example, you knew that after 1 year you will get $110. So the return was fixed. That's why this calculation was good, easy to do, and we will call this just discounting. But in stocks, we don't know where the share price will go after 1 year, or how much the company's profit will increase after 1 year, or how much the company's profit will increase after 5 years. So first, I have to estimate how much the company's profit will grow in the next 5 or 10 years. So when I am doing this calculation for a company, I have to do two things. I have to estimate the cash flow, and then I have to do discounting. So first, let's talk about cash flow. The difference between cash flow and net profit is just that net profit is what you have shown as sales and profit. You have shown that I made a sale, but every time when we make a sale and payment is supposed to come, sometimes the payment doesn't come. So in that case, cash flow tells us that this is the money that actually came to you. That is, you can consider cash flow as cash profit or actual profit. So this is a more conservative estimate of any company. So now you understand cash flow. So we move on to the next concept, free cash flow. Now, this free cash flow is the amount that after doing all your expenses, after buying new machinery, everything that is necessary for you to do business, you have invested money in that. And after that, whatever money is left with you, you can do anything with it. You can burn it if you want, you can store it, you can invest it, but your existing business will not suffer. The cash profit that is left with you after all expenses is called free cash flow. So I hope free cash flow is clear to you now. So now we come to the steps of DCF. This may seem a little technical to you, but trust me, if you repeat this video 2 or 3 times, pause and watch again if you don't understand, then in the second or third time, it will start seeming easy to you. This initial free cash flow basically means how much free cash flow the company has generated on an average in the last 3 years. Like, suppose in 2021, a company had $100 free cash flow, in 2022, $150, in 2023, $200. So I will add $100 plus $150 plus $200 and divide it by 3. So the figure that comes is my initial free cash flow. This was the first thing you might be thinking, where will I get this free cash flow figure? That how much free cash flow was there in 2022, 2023, or 2024 of any company. So I want to tell you that there are many free websites available in USA like Yahoo Finance, Finviz, Morningstar, Simply Walseb, and many others where you can get all this data for free, because our aim has always been that you people should become independent investors. To fulfill all these four things, till now we were giving education, we're giving advice too, but if you want to research yourself, then correct data about companies, accurate data, and correct tools were not available easily. But now there are many free resources available, where whatever data you need about any company, whether it's free cash flow or any other metric, you will get it for free. So from websites like Yahoo Finance or Morningstar, you will get any company's initial free cash flow. You don't have to do this calculation yourself. It's available on these websites. After this, now second thing, so how will you estimate this? You will look at the company's past free cash flow growth rate. So this data too, that at what speed the company's free cash flow has grown before, you will get on websites like Yahoo Finance or Morningstar. So if a company's free cash flow has grown at 10% in the last 5 years, then for the next 5 years, I will take a little less than that. After that, from 6th to 10th year, at what speed will the company's free cash flow grow? I have to estimate that. Now, because 6th to 10th year is very far in the future, it's difficult to predict that. So I will take that more conservative. I will probably take 5 to 6% after this. That is, after 10 years forever, at what speed will that company grow? So I prefer to take this as 0 or 1%, not more than that, because distant estimates should not be taken too aggressively. Now, the last thing, discount rate. Discount rate is basically how much return you want from any stock. Like, I want at least 15% return from stock market. If you want 15% return, then put 15%, whatever return you want. So when you have assumed all these things based on past data, now there is a DCF formula using which you can find the fair value of any share. But you don't have to apply any formula. You don't have to use any Excel sheet. There are many free DCF calculators available online. Websites like Guru Focus, Finbox, Simply Wallseat, Alpha Spread, and many others offer free DCF calculators. So now I will show you that calculator, how without knowing the formula, without knowing Excel sheet, you can find the DCF value of any share right now. This DCF calculation feature is live on many websites. You will go to any financial website that offers DCF calculator. You have to scroll down and you will find DCF calculator. You have to click on launch calculator. Now you can see all these things. One thing to remember here, you need a lot of data like initial free cash flow, market capitalization, current share price. All this you will get easily on Yahoo Finance, Google Finance, or other financial websites. There are websites which give all the data of stock analysis to retail investors for free and in a very organized way. There you will get all this data of any company for free, whether it's growth rate, market cap, debt, current price, or initial free cash flow. So when you go to these websites, you won't have to search for all these figures at all. Go to Yahoo Finance or any other website, find any stocks figures. But for now, let's assume that we are taking a company. So let's assume that a company's initial free cash flow is $1,000 and discount rate, that is how much return I want. So I want at least 20% return. Growth rate, I think I will usually look at this data by seeing how the company is growing in the past. So if a company is growing around 10%, then I will take moderate. But you can put whatever figure you want by choosing custom. Now I can put whatever figure I want. But for this company, I am taking moderate because I think 10%. Now, from 6th to 10th year, at what speed will this company grow? Fair assumption is that you always take this low, keep 5%. Terminal growth rate, that is after 10 years, at what speed will this company grow? Fair assumption again is that you keep this around 1%. Market capitalization, this data you will get on Yahoo Finance or Google Finance. Let's assume this. For this company, let's assume there is no debt. Margin of safety, that is, even after doing all this, there are some things where some assumption can be wrong. Your growth rate expectations can be wrong, so it's necessary to keep a safety. I usually keep margin of safety around 20%. So let's see a company whose free cash flow is a $1,000. Growth is moderate. Market capitalization is $10 million. So what is its fair value? Is this share overvalued or undervalued? You clicked on calculate DCF, scroll, and now the fair value after margin of safety has come, let's say $31, and currently this share is at $50. That means our calculator is telling that this company is currently overvalued. So you can use this calculator and many such calculators. Click on calculator. How much should you invest as lump sum? If you want to do goal planning, if you want to do retirement planning, plan your investments, or want to know how much difference can be in returns between stock market and CD, you want to plan your children's education. All these calculators are available for free on various financial websites. You can go to Bankrate, NerdWallet, Investor.gov, or any other financial calculator websites. So, how did you like today's video? If you liked it, then definitely like it. Also, subscribe to this channel and don't forget to press the bell icon. What is the biggest problem you face in stock analysis? I want to know this from you so that I make the next video on that topic in which you face the most problem in analysis and I solve that problem through that video. If you want more educational lessons like this, if you want to become a successful investor by doing in-depth investing study, then you can join Academy of Value Investing, whose link you will find on the card above and in this video's description. Also, this course is available for you in both English and Spanish. And if you want to know the best blogs or best books on investing, then you can follow my Twitter ID, where every day I will give you links to the best articles, best books, best websites on investing so that you can learn the best investing from the world's best sources. Hope you like this video. I will keep bringing more such videos. Until then, this is Nawazish signing off. Bye bye.